Interest rates have gone up by 0.5%. They're now at 2.25%. It's the highest level of interest rates in the UK since 2008. But how high will interest rates go? What does this mean for the UK property prices and the UK housing market? What should you be doing right now if you have existing buy-to-let mortgages? And what opportunities are there for property investors going forward? That's all coming up, so stay tuned. Before we get onto the video, let me tell you about the Baker Street Property Meet. It's the UK's largest property networking event on the last Wednesday of every month. We get 300 property investors networking and talking property. Make sure you join us. Details of this month's event are at bakerstreetpropertymeet.com. We've got a lot of news to unpick today and share with you some pointers for going forward. If you're new to this channel, make sure you subscribe and hit the bell icon. We put out a lot of videos each and every week, all dedicated to keeping you on top of your property investing game. So it looks like the chickens are coming home to roost from all that money printing that went on during COVID times. The UK, among other leading nations, were printing money like it was going out of fashion. Now, if you're going to print money, sooner or later, it results in inflation. And that's what we have had. If you look at the Bank of England website, they state the official interest rate is 9.9%. Now, very suspicious of, aren't you suspicious of prices in shops when something is £9.95p? You know they really mean 10, don't you? You wonder how much fiddling has gone on just to keep it under double digit. But we all know in our own lives that the real inflation that we're seeing in the basket of goods and services that we each consume, they've risen more than 10%. They've risen more than double digit. But the official rate is likely to increase still further. We're not at the peak level of inflation right now. So when America is doing something, if we kind of do the same thing and follow in its coattails, we can get away with it to a certain extent. But if we deviate, it becomes very, very difficult. And that's what the money markets are telling the UK government and the Bank of England. So in the US, the Fed recently raised interest rates by 0.75%. The UK, if they wanted to get a grip of this, should have raised it by that or a little bit more. But they've chose to increase it by 0.5%. You see, the problem right now is that the outlook for inflation doesn't look that good. Of course, there's the energy crisis and all of that, but the new Liz Don't Trust government is likely to bring in a whole bunch of unfunded tax cuts, estimated to cost £30 billion, and that's going to be just added on to the national debt. And by adding on to the national debt, we mean further money printing. When one country in isolation goes around printing more money, then basically there's more money available, and then the value of that money goes down. It's not just me saying this, it's the money markets. And the money markets are saying that they don't value our pound. The UK pound to the dollar is now at $1.13 to a pound, which is the lowest level we have seen for the last 37 years. A weak pound further contributes to inflation because any commodities or goods that you have to buy from abroad, then because of the conversion rate, they cost more. So it kind of imports inflation through that means. And the only way of dealing with inflation and a sliding pound is to put up interest rates. So where are interest rates likely to go? Well, the next decision by the Bank of England is actually not that far away. It's the 3rd of November. Now, I believe on the 3rd of November, we'll see a further rate rise. The direction of travel is up. How high will they go? Well, the money markets are factoring in a Bank of England rate, interest rate, of around 4.5% next year. And the reason for that is that inflation is not at its peak. It's got further left to rise. And also, the new Liz Truss government is planning £30 billion of unfunded tax cuts, which gets added to the national debt. So what does all this mean for UK property investors, particularly if you've already got buy-to-let mortgages? If you have a buy-to-let mortgage and you are not tied into a fixed rate, it's on a floating rate right now, I would seriously consider locking into a 5-year fix and do so before the next interest rate decision, which is 3rd of November. If you have a fixed rate mortgage, and let's say it's got 1 year left to run, or 18 months, or even 2 years left to run, and you do not have an early redemption penalty for coming out of it, then consider coming out of it, exiting that mortgage, and locking into a 5-year fixed rate right now. Even if you're currently locked into a fixed term buy-to-let mortgage, and you have a redemption penalty, look at the total cost. Factor in the fact that interest rates are going to be 4.5% next year. So the rate you'll be paying on buy-to-let mortgages will be higher than that. It's still for many people, it'll be cheaper to pay the early redemption penalty, exit out of the existing buy-to-let mortgage, and lock into a fixed rate at today's rates. Everyone will have to make up their own spreadsheets and do their own calculations as to whether that's going to be worthwhile for you. But I thoroughly recommend you spend this weekend looking through your buy-to-let mortgages and deciding what your next course of action is. But bear in mind, interest rates are on the way up, and plan for 4.5% Bank of England base rates next year. What does this mean for the housing market and property prices? Well, one thing I don't foresee is a housing price crash. There is still a huge amount of demand for the available supply and the amount of properties that are actually being built. I don't see growth, and I see small falls in some areas regional areas where there's a little bit of oversupply, but there's no national crash. What we will see is massive challenges for those with too much debt. If you're carrying too much debt on a property with these rising interest rates, we will see a rise in repossessions, really for the first time since before the credit crunch of 2008. And the government do not want a housing price crash. The UK economy, and more importantly, voter psychology, relies so much on a healthy housing market. And we're likely to see the Liz Truss government announce some helpful measures for the property sector, such as some changes to stamp duty. Where you are going to see some changes is in the commercial property marketplace. 2023 is going to see a recession. Recessions always have a dampening effect on commercial property values. There's also a strong correlation between interest rates and commercial property values. Basically, commercial property is valued based on the rental income that it produces. If Bank of England interest rates are 4.5% and you can get 4 or 5% on your savings, then if you're going to invest in a commercial property, your returns on your money invested in a commercial property needs to be higher than what you'd get from a safe investment in the bank. So as interest rates rise, then investors investing in commercial property buy-to-let expect higher yields, and therefore the values of those commercial properties tend to fall a bit. So what we will see as we go into the recession is a huge opportunity with commercial property values coming under intense pressure, but residential values in many areas staying stable. And with the government's new permitted development rights, which allow you to convert commercial properties to residential use, you can convert from low-value commercial stock into high-value residential stock without going through convoluted planning permission. Now, if you want to find out more about doing this particular thing, I run some training courses which teach people how to get involved with commercial property conversions. You can sign up for one of my free webinars at this address here. So what does it mean for property investors looking to raise finance? Well, obviously, things like bridging finance and developer finance and also commercial mortgages, buy-to-let mortgages are going to increase substantially over the next year. But here's the thing, here's my prediction. I'm not entirely convinced savings rates for savers are going to increase at the same rate as debt interest. And you'll notice that many of the banks offer caps. What I mean is, let's say Bank X is offering 3% interest. They will do so for the first £50,000 you have deposited in that account. Anything after that £50,000 earns interest at a far lower rate. So this means that for people with cash, they have a problem. The problem is that putting their money in the bank will earn them a very, very low return on their savings. Meanwhile, inflation is galloping away at 10% plus. So what I see is more property developers and investors seeking private investor funding to fund their property projects and putting that in the mix as well as bank finance. because there will be no shortage of private investors with cash looking to deploy in property projects which will get them a higher return than money in the bank. We'll talk a lot more about raising funding from private investors for your property projects in a future video, so make sure you subscribe and hit the bell icon to be notified when we release that. Let's wrap this up with some thoughts. We basically have a massive debt post-COVID. That has to be paid back. Now you can pay it back by raising taxes, but raising taxes is not very popular. And of course, when you do things that aren't very popular, you lose elections. Inflation is a tax. It's a tax by the back door, but politicians feel they can get away with having inflation because they feel that they don't get directly blamed for it. So if we have a few years of 10% plus inflation, what we will see is an eroding away of that debt. But that's all very great, but the people pay for that because it's a stealth tax. So when inflation is rising, one of the surefire ways of getting ahead in an inflationary climate is to look at real estate. Now, I've talked about rising interest rates, but we've got to remember one fundamental thing here. Interest rates, yes, even if they go up to 4.5%, they're still far less. It's less than half of the inflation rate. When interest rates are less than the inflation rate, you can be quids in by buying the right type of real estate. Because when you buy property, you buy it on a mortgage. If you only have to put down 25% and you're borrowing 75%, the value of that debt gets frozen in time. Yet the long-term inflationary effect of that debt is higher than the rate of interest you're paying on it. But the key to being successful in property over the next few years is to adopt the right strategies. Now, if you join me on one of my webinars, I'll explain why commercial property is the correct strategy for you guys to be optimizing the opportunities that are going to be presented in this recession. So join me on one of those. I'll leave the link in the description below. So that's it for this video. Tell me what you think in the comments below. See you guys next time. High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.